In the previous episode, we touched on the impact of moving cargo that was ocean freight to air freight to hit quarter end numbers. In this episode, episode 3, we will expand on that and consider other reporting implications for supply chain. Now, you probably recall this example from episode 2, where in order to hit that quarter end revenue number, we had to convert ocean to air freight. And the result, sure, we hit budget, made bonus, but we blew out our greenhouse gas emissions. Now, that needs to be justified in our reports as much as our financial results have to be as well. You may want to argue about that conversion of ocean to air freight and say, well, it was in the shareholders' best interests. However, buried somewhere in those financial reports are the costs of that air freight, and in some cases, the costs of the air freight logistics exceed the value of the revenue that those goods were going to generate. It was just that revenue was enough to hit budget. So, if carbon is a measure of efficiency of supply chain, then appreciating the impacts of decisions like that on not only the business, but the shareholders as well, is important when it regards to reporting, because there could be a better way of running the operation so you both hit your targets and operate efficiently. Now, this is what businesses are finding. Listed companies are already hitting the requirements for Scope 1 and 2, and now for Scope 3 emissions, there is the requirement for additional ratios, and I've listed 2 common ones. What we're also seeing is for private companies, they will also need to begin to record the Scope 3 emissions of their supply chain, because they have to deal with listed companies. Banks are listed companies. There are companies that do valuations that are listed as well. Now, in order for them to get the loan, they may need to have this additional reporting. Also, if they want to list on a stock exchange, then they will have to prove that they can not only do their emissions reporting today and have got a history of doing that, no doubt, but also the systems they have in place for recording emissions data in their supply chain are robust enough not just to tick the box for the IPO, but also prove that they can be sustained once the business is listed. So episodes 1 through 3 have dealt with the history and theory of Scope 3 emissions, so to speak. Episode 4, we actually look at real examples of how customers are being brought into this space of reporting on Scope 3, even when technically they don't need to. So to understand more about that and how they are responding, please join us in episode 4.